All right, let's dive right in. In the world of trading, everyone is chasing that one magic formula for picking winners, right? But what if I told you the single biggest key to success has almost nothing to do with picking winners at all? Today, we're pulling back the curtain on the one skill that separates the pros from the 90% who fail. And honestly, it might just change the way you look at the markets forever. So let me ask you something straight up. What do you think is the number one reason most traders just don't make it? Is it a bad strategy? Is it just terrible luck? Maybe a market crash they didn't see coming? Just take a second and think about it. Here's the answer, and it kind of goes against everything you'd think. It's not about having a brilliant offense. It's about having absolutely no defense. You see, successful trading isn't about how much you make when you're right. It's all about how little you lose when you're wrong. And this right here is what we call the path to ruin. Most beginner traders are just obsessed with profit. They have this grand plan for winning, but they have zero plan for what happens when a trade goes against them. This total lack of a defensive strategy, a lack of risk management, is what completely wipes them out. So, what even is risk management? Let's break it down. Think of it like a set of rules you live by to keep your losses in check. Its only job is to be a shield, protecting your trading capital from taking a hit so big you can't recover. It's the thing that keeps you in the game long enough to actually win. The best way to really get this is to see it in action. So let's tell a little story. A tale of two traders. They make the exact same trade on the exact same day, but their fates completely different. All because of this one little thing. Okay, so let's meet our two characters. On one side, we've got Trader X, the planner. This person follows strict rules, only risks a tiny 2% of their capital on any trade, and always uses a stop loss. And on the other side, we have Trader Y, the gambler. No rules, no plan. Their entire strategy is just hope. And just to make it a totally fair fight, they both start out on a completely level playing field. Both have the exact same starting capital, 30,000 rupees. So, they both enter the same trade, feeling pretty good about it. They're confident the market is going to go up. But the market does what it wants. The price turns and it starts falling hard. This right here, this is the moment of truth. For Trader X, the planner, honestly, it's not a big deal. Their stop loss, which they set up beforehand, triggers automatically. Boom, they're out of the trade. The loss is exactly what they planned for, 600 rupees, just 2% of their capital. It's not a failure, it's just the cost of doing business. But Trader Y, the gambler? Oh boy, no stop loss. They're just sitting there, watching the numbers go red, hoping, praying it'll turn around. As the loss gets bigger, panic finally sets in, and they sell. The damage? A devastating 2,000 rupee loss. Now, let's zoom out. Imagine this happens just 3 times in a row. The difference is just staggering. Trader X is down 1,800 rupees. Sure, but they're calm. They're still in the game. Trader Y has lost 6,000 rupees. A huge chunk of their money is gone. They're shaken, and they're on a fast track to ruin. So, the real question is, how can you be Trader X? How do you set yourself up to win by losing small? Well, it all comes down to a really simple set of rules. The rules of the game that all successful traders live by. It really just boils down to a simple 3-step framework. First, you define your potential reward versus your risk before you ever get into a trade. Second, you figure out your position size based on that risk. And third, and this is the hardest part for everyone, you have to stick to your plan, no matter what your gut is screaming at you to do. Let's talk about that first step, the risk-to-reward ratio. A really solid rule of thumb is to only take trades where you stand to make at least twice what you're willing to lose, a 1-to-2 ratio. Why? Because it means you can be wrong more often than you're right and still be profitable. Think about that for a second. And now for the golden rule, the one that protects your capital above all else, position sizing. You should never, and I mean never, risk more than 1-to 2% of your total account on a single trade. This one rule makes it almost mathematically impossible to blow up your account. It keeps 98% of your money safe at all times. Okay, so knowing the rules is one thing, but actually following them day in and day out, that's a whole different ballgame. You see, the real battle in trading isn't with the market. It's not on the chart. The real war is fought right inside your own head. This all requires a huge mindset shift. A loss is not a personal failure. It's just an inevitable part of trading. When you manage it correctly with a plan, a small loss just becomes a business expense. Seriously, it's like paying rent for your office. It's just the cost of finding opportunities. And if you want to stick to your plan, you have to conquer your emotional enemies. There's fear, which makes you sell winners way too early. There's greed, which makes you hold on to losers for way too long. There's overtrading, that desperate need to win it all back after a loss. And of course, FOMO, the fear of missing out that sucks you into terrible trades. Your risk plan is the only defense against all of them.
And this is why risk management isn't some boring restriction that's holding you back. It is the only path to sustainable long-term profitability. It's the absolute foundation of any lasting strategy.
When it comes down to it, there are really only two paths. There's the gambler, always hunting for that one big lottery ticket win, all while ignoring the small losses that are slowly bleeding their account dry. Then there's the professional trader. They're obsessed with managing the small losses because they know that allows them to collect consistent gains and just methodically build their account over time. So what does your long-term toolkit for success really look like? It's these four things: the discipline to follow your rules, especially when it's hard; the consistency to apply them to every single trade, no exceptions; the acceptance that losses are going to happen; and finally, having unwavering trust that your plan will work out in the long run. So after all of this, the rules, the psychology, the tale of two traders, everything we've talked about really boils down to one final crucial question that you have to ask yourself. Are you trying to build a professional trading business with rules, with a process, and a plan for managing your expenses? Or are you just showing up every day, buying a lottery